This is Bروکس, and this is my price action trading course. The current module is about trading options based on daily charts. So why trade options on the daily charts? Well, one obvious answer is traders are always looking for ways to make money. Day traders don't like much overnight risk, and options allow day traders to take positions on patterns that they see on the daily charts, patterns that might take several days to reach targets, and the day traders can take those positions without much overnight risk. The absolute risk is smaller than on the underlying stock. So if you trade puts or calls or spreads, what you stand to lose if the absolute worst happens is always going to be much less than the underlying stock. I'm talking about if you're buying options. I'm not talking about if you're selling. Obviously, if you're selling naked puts or naked calls, you can lose as much as you can trading stocks. Also, the cost of execution and the profit trading options is about the same as it is for stocks. Most importantly for most traders is peace of mind. The less you have to worry about money, the more objective you are about your decisions. And if you have a big gap against you in the morning and you have an option position, it's going to be much less costly than if you were holding a position in the underlying. You hear me many times in this course talk about trading small, especially when the stop has to go far away. However, for option traders, they can use stock replacement strategies as an alternative to trading small. For example, let's say the market is in a strong bull trend and the stop has to go 3 times further away than you normally want your stop to be. What an options trader will do, or what a stock trader who also trades options will do, is he'll sell out of his stock and he'll replace his stock with an option strategy. The most obvious and easy ones are he might buy a call or a call spread. If the market's in the breakout phase of a bear trend and there are no pullbacks and the stop has to go far, far above where you are right now, an alternative to trading very small and putting the stop far away is to sell out of your stock and buy back your short and replace it with a simple option strategy. For example, buying a put or buying a put spread. And therefore you immediately greatly contained your risk. For example, if you buy a put, the most you can lose is the price of your put, and that might be 1 or 2% of the current price of the underlying stock. So your risk has become greatly smaller by replacing your stock position with a position in the options market. A lot of traders don't trade options, but that is a very popular strategy for traders who trade both stocks and options. There are other more advanced strategies like collaring up, but I'm not going to go through them in this course. I might do that in a subsequent course. Sometimes there's something going on in a stock that makes you want to be long, but the risk is too great. And option traders have an alternative to trading a very small size. So let's say you have a very large open profit and the profit just keeps growing and now your stop is very, very far away and the total dollars at risk is much greater than you're accustomed to trading. So you know you have to reduce your position size. Beginners tend to look at their big open profits and say, hey, it's other people's money. No, it's not. It's in your account. It's your money. So you have to adjust your position size based upon your actual risk at the moment. And you can either greatly reduce your position size. If that makes your position size so small that it's not worth continuing to hold the position, you have an alternative. You could simply sell out of your entire position and replace it with an option strategy. And the obvious one, if it's a bull market, is to buy a call, or to buy a call spread if you're expecting a move that will go up for 4 or 5 or 10 more % over the course of the next several weeks, then go ahead and buy a call spread. If you're expecting a more modest move, or if you're expecting a much faster move, a very sharp move up, just go ahead and buy a call. Other strategies like collaring up are beyond the scope of my intentions for this course, and I may deal with them in another course in the future. But right now, I do want to talk a little bit about what you do as an alternative to using a stop that's just too far away, and you don't want to trade too small, and buying a call. Sometimes if you either own a stock and the stop is very far away, or if you're thinking about buying a stock and the stop is very far away, you can have an alternative to simply trading very small, and options offer a very good alternative. Let me give you 2 examples. One is, let's say you bought a stock somewhere down here, the spider on the daily chart, and now it's up here. And let's say your stop is down here, and you've been scaling out, so now you're down to maybe 100 shares. But your 100 shares times $5, that might be more than you'd care to risk. That would be $500. You might say, well, I don't want to get down to 0. I still want to participate. Well, an alternative is to sell out of your spider's contract or your spider shares, and instead replace your stock position with an options position, and an obvious one would be a call. Just buy an at-the-money call 1 month out or 2 months out, and so at this point you'd be long a call. If you're looking to hold for 2 or 3 months, maybe for a 5 or 10% gain, you could go ahead and buy a call spread. But if you're thinking the market might just go up another 2 or 3% over the next few weeks, just go ahead and buy the call. Let's say instead of being long all the way down here, let's say you're flat for whatever reason and you decide you want to buy up at this area. You know your stop goes down here, and if that results in a risk that's too big for you, don't buy the stock, just go ahead and buy the call. You might be able to buy an at-the-money call, 3 or 4 weeks out for $2. In other words, times 100 shares, your actual cost would be about $200. Yes, you won't make as much as you would had you bought 100 shares of the spider, but your risk will be less. If you buy the spider and your stop is down here, you're risking $500 on 100 shares. If you buy a call for $2, your risk is $2. The most you can lose is $2. And yet you'll still have a good gain if the market goes up here. So options provide an alternative to stocks whenever the risk is big. In other words, whenever your stop is far away. For those traders who did buy down here, if the market is up here, they can argue, well, I'm trading other people's money, and therefore I don't care if I lose $5. That's not true. Once the money's in your account, it's your money. It's not other people's money, it's your money. And you have to trade it as if you just put the trade on right here, not as if you put the trade on down here. You always have to mark your position to the market. So if you're long, it doesn't matter if you bought down here. If this is today and you're currently long and your stop is down here, this is your risk. It's not other people's money that's at risk, it's your risk. And you constantly have to be reassessing your position based upon your current stop, your current position size, and the current price. It's your money. It's always your money if it's in your account. Here's the 5-minute E-mini chart, and let's say for whatever reason you did not get long earlier and you decide to get long up here. You know that your stop is below the bottom of the bull spike, and you say, well, wow, that's 8 points away. I can't risk 8 points. And yet I only trade one E-mini contract, so I can't take the trade. Well, an alternative to doing that is to use options as an alternative. You could simply go ahead and buy an at-the-money weekly spider call, or if it's still too expensive, buy a slightly out-of-the-money spider call. Options are a very good alternative to stocks, and especially a big market like the E-mini or the spider. Spider calls have tremendous volume, and they're excellent alternatives to taking outright positions in the spider or the E-mini. Let's give it an alternate example here. Let's say you happen to buy here, and you're still long here, and your stop is now, 7 points away, and you don't want to risk that much. Yet you think the market is still going a lot higher. You should be reducing your position size to keep the risk the same. But if it's too far away and you can't reduce your position size, instead of continuing to hold your E-mini and using a stop that might be too tight, like maybe below this bar, what you could do is simply sell out of your E-mini position and go ahead and buy a spider call, an at-the-money spider call, a weekly call. And that would be a very good alternative. Let's say you bought it and it cost 80 cents. Let's say you bought a weekly call. The most you can lose is 80 cents, which times 100 shares is $80. So the most you can risk is, the most you can lose is $80. And if the market goes up for a measured move based on the height of this spike, you probably will make $80 by the end of the day. There are stock replacement strategies for bearish positions, and if a trader finds that his stop has to be so far above his entry price that the position would be so small it's not worth taking, yet he feels the trend is strong and he wants to participate, he has a stock alternative. He has an alternative to his stock, and that is in the options market. He could buy a put, or he could buy a put spread. Let's say he sold way up here and the market's way down here, and his stop has to be much higher up than what he is comfortable using. He could just buy back his stock, his short, for a profit, and then go ahead and put on an option position like buying a put or buying a put spread, and that will allow him to continue to participate on the downside. There are other alternatives like ratio put spreads and calendar put spreads and put flies, but they're beyond what I want to discuss in this course. Here's an example of a bear trend in the spider on the daily chart, and I want to talk about it in two different ways. Let's say you are flat and you see this big bear spike occurring late in the bear trend, and you decide that the market is going down more, and you're correct. That makes sense whenever the trend is this strong. And you decide you want to sell, to go short, but your stop might be above the top of this bear spike. It might be above the most recent lower high. It might even be simply above the beginning of this bear spike. In any case, let's say it's further away than you want to risk, yet you want to participate on the downside. A good alternative is to simply go ahead and buy a put. You can wait for a pullback and buy the put at the market, or you can wait to see if the market trades below the low of the prior bar, and at this point buy a put. If you buy a put here and the market goes up here, that's $2 on the spider. You might be very nervous if you shorted the spider, but if you bought an at-the-money put, maybe you paid $2 for it here. At this point it might be down to $1, but your risk is still $2. Even if the put goes to zero, you lose no more than $2, and it allows you to hold on. And at this point, you might be able to exit your put for $3 and have a $1 profit. You might not be comfortable emotionally had you shorted here, the spider, if the market ran up, $1 or $2 above your entry price. But the put is a good alternative to that. The other alternative is that I was talking about is, instead of being flat down here and then wanting to get short, let's say you were short from up here and now the market's down here, and you think, gosh, my stop has to be above the bear spike or above the lower high, and that's far more than I want to risk. Let's say it's 5 times more than I want to risk. You can reduce your position size to a 20% size, but if the position size is so small that you don't want to continue to hold, you can replace your stock position, your short spider position, with a put. So you simply buy back your stock for a profit. If you sold it up here, you have a big profit. And you can then go ahead and buy a put or a put spread to try to capture any additional gain that the market might offer you. Let me go over abbreviations. These are probably familiar with everyone. At the money, ATM, out of the money, OTM, in the money, ITM. So if the stock is at 100 and you buy 100 call, it's at the money. If you buy 100 put, it's at the money. If you buy a 90 put, it's way out of the money. If you buy a 90 call, it's way in the money. AIL, always in long, it means it's a clear bull trend. Always in short, a clear bear trend. And how long should you hold options? Day traders are always looking for a quick profit, and when I trade options, most of my exits are usually within 1 to 3 days, although sometimes I'll hold positions for several weeks. For example, if I'm trading based on a pattern on the weekly chart, I may be trading an option that expires 2 or 3 months out, and I'm willing to hold the option for several weeks if I think that's how long it will take for the option to reach my profit target. Which option to use, an at-the-money put or a call? Monthly options, weekly instead of weekly. In general, I use at-the-money puts and calls. I also do a lot of spread trading, and I usually use monthly options and not weekly options when I'm planning on holding trades overnight. You know, the weekly options expire on Friday, so you don't want to be taking an overnight position if today's Wednesday, because you'll lose too much due to time decay. And I usually trade the nearest option that has at least 2 to 3 weeks remaining. I usually prefer 1 to 2 weeks remaining in case I get into the position and the market starts to go sideways, yet I still think my position is valid. If the option expires in 2 weeks, the time decay is too great. I lose too much every day, and it makes it harder to make a profit. Okay, how much does a $1 call really cost? Okay, if I pay $1 for a call, okay, that call entitles me to buy 100 shares of stock at whatever strike price it is. So let's say it's a stock that trades at $50, and I buy a $50 call, and I pay $1 for that call. I'm entitled to buy that call for $50, even if the stock goes up to $60. So in other words, I can pay $50 for it, even though it's currently $60. So I immediately have a $10 profit, and I paid $1 for the option. So my net profit is $9. Okay. If the call costs $1, that's $1 per share. You know, one option, one call controls 100 shares of stock. So if I pay $1, if the price on my computer says that it's $1 for the call, I'm actually paying $100 for that call. And if I pay $1 for the call and sell it for $2.50, I made $1.50, but that's times 100 shares, so my actual profit is $150. Execution costs. You can usually find brokers that will charge you $1 commission to buy, and then another $1 commission to sell. So if you buy 10 calls, your round trip commission would be $20. $10 to enter, $10 to exit. And there's also a bid-ask spread to consider. Anytime you buy anything, a stock or future, there's always a bid-ask spread. And the bid-ask spread is very big on thinly traded options. And because it's so big on options that don't trade very actively, it's better not to trade them. In huge markets like the spider, the spread is usually only 1 tick, which is 1 penny times 100 contracts, 100 shares is $1, per call or per put. The bid-ask spread can be huge. When Apple's trading around $600, the bid-ask spread can be 10 cents, sometimes 20 cents. However, you can say, well, I don't want to pay 10 cents spread on a call. That's way too much. But on a percentage basis, a 10 cent spread on a $600 stock is exactly the same as a 1 penny spread on a $60 stock. And that's a very good spread, a very small spread for traders. So when Apple has a 10 cent spread or even a 20 cent spread, that's actually a very good deal for traders. And what are the execution costs? Let's say you're talking about the spider and you bought a call and paid $1.70 for it. you'd be buying it at the asking price. If you immediately turned it around and sold it, and the spider itself did not move a single tick, you'd have to sell it at the bid. Let's say it's $1.69. So you'd immediately lose $1. Okay, 1 penny spread times 100 shares. But you would also pay $1 to buy, $1 to sell in commissions. So your total loss would be $3. So even though the spider did not move a tick, it would cost you $3. And if you were trading 100 calls, that would be $300. Okay, at the money volume can be huge, and that creates the tightest bid-ask spread. And with very big volume stocks and ETFs, that allows you to use market orders. Like the spider, you can usually use market orders when you're trading at the money calls on near-dated options, like weekly options or options expiring, just a few weeks out. Okay, what exactly is at the money, ATM? The stock is rarely exactly at the option strike price. For example, let's say the stock is 140.25. There is no strike at that price. There's a 140, there's a 140.50, there's a 140, a 141, but no 140. One nice thing about the spider is a lot of times they'll have strikes that are 50 cents apart. So on the weekly options, a lot of times they'll have a 140.50 call or put. So if the spider's at 140.40, you're not forced to buy the 140 call or the 141 put. You can buy the 140.50. Okay, so at the money to me is the approximate nearest strike price to the underlying. I prefer slightly in the money to out of the money because the in the money option will have a broader range than the out of the money option, and that gives me more opportunity for profit. When you can't decide in the money or out of the money, it doesn't matter. Just choose either. An example: let's say a stock is at somewhere in the range between 99.80 and 100.70. Okay, I would trade the 100 puts. Excuse me, the 100 calls. So even 99.80, the 100 calls would be slightly out of the money, but only slightly. So I would, at 100.70, the calls are way in the money, but I would still probably trade the 100 calls instead of the 101s. If it's at 99.40, I would trade the 100 puts, even though that's way in the money. But I'd rather do that than trade the 99s, which is out of the money. Here's an example comparing out of the money and at the money calls. On the left, here's the spider, and it's a line chart, not a bar chart. And this is what took place today. We had a 90-cent range. Okay, the market opened up at the money was 141 earlier in the day. That's the closest strike, right? So at the money is 141. Had I bought an at the money call at the absolute low tick, well, let me put it this way: the 141 call had a range of 59 cents today. The spider itself had a range of 90 cents. But if I instead bought the out of the money call, the next strike up, the 142, it's a lot cheaper, right? It's 20 cents instead of 60 cents to buy it, but the range was only 32 cents. And if your commissions are a penny in and a penny out, and the spread is a penny in and a penny out, that means your overhead is 4 cents. And when your range is 32 cents and you have 4 cents built-in overhead, it's very hard to make much of a profit, because you're not going to be buying the low tick, you're not going to be selling the high tick. You'll be buying somewhere in here, 30 cents, and you'll be selling here, 40 cents, and then you have 4 cents overhead. So you're making 6 cents profit on a win, and you're losing 14 cents on a loss. And it's impossible to make a living when your losses are 2 times or more greater than your wins. On the other hand, if you have a 60-cent range, 59-cent range, it's much easier to make a profit. You buy down here around 70, you sell up here for around $1, and you can make 30 cents on a good move. So use the chart of the stock to make your trading decisions. I don't look at the chart of the options when I'm deciding, should I buy or should I sell. To me, the options are a reflection of what's going on with the underlying stock. And I place my entry orders in the options market, and I can exit with limit or market orders, but I'm making my decisions based upon what the underlying stock is doing. So for example, if the spider looks like it's a buy and I'd rather buy options, I immediately buy at the market or with a limit order at the money call, assuming that I'm trading the options today instead of the spider, which I sometimes do. Sometimes I'll take swing trades in the spider calls or spider puts, day trades, swing trades, holding for an hour or two or three, and I'll take scalps in the E-mini, the futures contract. Usually when I'm trading options, I'm doing it for a trade that, when I'm trading options on the daily chart. And a trade means that my goal is to reach a profit target within 1 to 3 days, and then I get out. So I get out with a profit or with a loss within 1 to 3 days. And I rarely lose more than half of the cost of the option. But I also never hold onto the option and hope that the option goes my way, and I never get greedy. Once my goal is no longer likely, I just take my loss and get out. And once I achieve my goal, I take my profit and get out. Profits disappear very, very quickly in options. So if you get a surprisingly big profit within a day or two, it's usually better to exit most or all of your position. In general, if the value of the option doubles in price, take at least half off. So if you paid $1 for the option, and then yesterday and today it's worth $2, take at least half off, if not all off, if it's achieved your goal. Okay, time decay erodes profits. Okay, let's say you buy a spider call, and the spider stays the same. It does not move a tick up or down, right? Well, tomorrow your call will be worth 10 cents less. The next day it'll be worth 10 cents less. So there's a certain amount of time decay, usually about 10 cents a day in the spider. And you have to be aware of that, so don't hold options too long. If you buy an option, a put or a call, while the market is moving up very quickly, the option price usually goes up faster than expected because a certain amount of uncertainty gets built into the cost of the option. And that increase in volatility increases the uncertainty and the risk to anyone selling the option. So the price of the option goes up faster than the market. And if the market suddenly reaches your target and then starts to go sideways, the value of the option will shrink very fast as volatility shrinks. So if you have a big profit on a very quick move, the option is extra inflated because of the quickness of the move. You should always take at least part, half, sometimes all of the position off. And what about the spreads? Spreads take a big move to become profitable. If, for example, if you buy, let's say the stock is at 100 and you buy a 100, 105 spread, right? For you to make a profit on that spread, you need the market to move up close to 105. And if it does not get close to 105, you're not going to make much profit. If your goal is to get out in 1 to 3 days, in other words, if you think the stock is going to go to 101, don't buy a spread, 100, 105 spread. Don't even buy a 100, 101 spread. Simply buy the call outright. Because if your goal is short term to get out in 1 to 3 days, the spread will not have enough time and the market will not move enough for you to make a profit. Also, you're paying double commissions, and you're paying double bid-ask spread cost, right? So if you're buying a call spread or a put spread, you have to be going for a much bigger move, like a 3 or a 4 or 5% move in the stock. And if you're just looking for a little, 1% move, just go ahead and buy the call outright if you think the market's going up, or if you think the market's going to fall 1% tomorrow. You just go ahead and buy a put. In general, if you're buying a spread, it's only going to be worthwhile if you're expecting a move of about 5% or even 10% at some point over the next several weeks. For example, let's say you buy a 3 to 5% spread, okay, where the strikes are 3 to 5% apart, okay? So let's say the spider's at 140, and you buy a 140, 145 call spread. So you buy the 140 call, and you sell the 145 call to help finance the cost of the purchase. In general, when you're buying a spread, you want the space between the strikes to be 2 to 3 times bigger than the cost. So if you're buying, let's say a put spread, let's say you're buying a 140 put and selling a 135, the difference in price is $5, right? So if you're going to buy the 140, sell the 135 put spread, you don't want to be paying more than 170 for it, okay? I mean, that 170 is good. A lot of times it'll be as high as 250, but never pay more than 250. So never pay more than half of the distance in the spread. Sometimes if you want to make the ratio 3 to 1, you have to go a little bit out of the money, which is okay. But if you're expecting a big move, 5 to 10% move, going a little out of the money is okay, because you're expecting the move to go well beyond your short strike price anyway. Okay, let's say the spider's at 140 and you think it probably will fall to 135. In other words, about a 4% move in the next couple of weeks. You might buy a 1 to 2 month out 140, 135 put spread, and you can usually place it as a spread order. Most brokers allow you to place it as a spread order using limit orders. For example, you might buy it at 170 or better. So you get filled, let's say you get filled at 170. I'm sure you've read about more complex option strategies, and if you watch television, there are shows that sometimes discuss option strategies. Every now and then, an options trader on television will talk about a strategy that will have a payout much bigger than the risk. So for example, he might buy a put butterfly trade, which is basically buying a put spread and then selling a lower priced put spread. So for example, let's say he buys a put fly and he pays $1 for it. He'll argue that, hey, you might be able to make $5 on your $1 investment. The most you can lose is $1, and the most you can win is $5. So why not take the trade? In fact, why not take all kinds of butterfly trades? Besides the obvious problem of 4 legs to the trade and 4 times the commissions and 4 times the spread, there's a much more important problem. Remember, there are no perfect trades, and anytime you see a trade where the reward is much greater than the risk, you know that you're going to lose most of the time. The trader's equation tells you the probability will be very low. Remember, you're trying to take money from institutions, and they're not going to smile and happily hand you their money. So anytime they're going to dangle a big reward in front of you with very little risk, you have to be aware that you're going to lose most of the time. And if you don't mind losing most of the time, then go ahead, take those strategies like put flies or call butterflies, and occasionally make 5 times your risk. But that means you're probably losing 3 or 4 times every time you win, and you have to also consider the emotional factor. Are you going to be happy losing 70% of the time, 80% of the time? I'm personally not that way, so I usually avoid trades where the reward is so much greater than the risk, because I know that the only way that can happen is if I lose most of the time. And I like to win. I don't like to lose. So I usually avoid very low probability trades. Okay. Remember, if the stock falls $1, right, the value of your call will fall 50 cents. And if you look at the bid-ask spread, you'll see that the bid-ask spread is 50 cents below the price that you paid. However, unless a trade takes place in your particular call, the stop won't get triggered. Let me give you an example. Let's say Baidu is at 100. and you buy the at-the-money call, the 100 call, and you pay $3 for it. And you say, well, I don't want to lose more than 20 cents. I'm going to put a stop to exit at 280. So if my call falls to 280, I'm going to get out and take a 20-cent loss. There's a problem with that. Let's say Baidu starts to sell off and it falls down to 99, right? That means the value of your call is probably now worth about 250. And if you look over at your positions, you might find you're still holding that 100 call and it's now worth 250, right? How could it fall to 250, well below your 280 stop, and your stop not get filled? Well, it's because the Baidu options are not actively traded, and it's possible that no trades took place in the Baidu calls, even though Baidu fell $1 and the value of the call fell 250. Your stop at 280 only gets hit if there's a trade that takes place in that call at 280 or below. So right now you're looking and you're saying, Baidu's at 99, my call is at 250, and I'm still long and the market's falling. What am I going to do? Okay? If someone finally places a trade in that call at 210, if someone buys the call, sells the call at 210, right? Remember, you bought it at 3, and it's way below your 280 stop. Okay, so somebody finally buys a call or sells a call, and the trade takes place at 210, right? Okay, this is the first trade that took place at or below your stop price. So now your 280 stop becomes a market order, right? You'll get filled at the bid, but the bid might be 190, right? There might be a 20-cent bid-ask spread in the Baidu 100 calls. So now you'll get filled at the bid, which is 190. So your 280 stop got filled at 190, 90 cents worse than you thought it should be filled. Okay? That's why you cannot use stops when you trade options, or why you should not use stops. What you do instead is you look at the underlying. You look at the chart of Baidu, the stock itself, and if it looks like the premise is no longer valid, okay, if it looks like your premise, your thought that the market was going up is wrong, you get out. So you quickly go to Baidu and you get out with a limit order at the best price you can, which usually means at the bid. Don't be greedy. You're wrong. Just accept it. You're going to be wrong a lot in trading, and when you're wrong, just accept it. Get out and look for the next trade. Take your loss. Don't get greedy and try to minimize your loss, hoping that the market will go your way a little bit so you can get out with a better, with a smaller loss. When you're wrong, just get out. Okay? So once you decide that you're wrong and that your underlying premise is no longer working, place a limit order that gets you out within seconds. You can exit at the bid without, or even a little bit worse. Just get out. Don't try to save a couple ticks. Just get out when you're wrong. So when should you enter an option position? As soon as the setup is clear. You look at the daily chart, the weekly chart, the 60-minute chart. Just before I typically enter just before the close of the day. Sometimes I'll enter at any time during the day if the market action seems like it warrants putting on an option position. But a lot of times if I'm trading the daily chart or even the 60-minute chart, I wait for just before the close of the day because I want a strong signal bar before I enter. When to exit an option? Usually when the position on the underlying tells you that the trade is over. So you, for example, you stay in until the always in direction reverses, and if a stop on the underlying would have been hit had you taken the position in the underlying, then you just go ahead and exit the option immediately. If the profit if you had taken a position in the underlying and the profit would have reached twice your risk, or if the option itself doubles in price, that's a good time to take half off, or sometimes even your entire position off. So if you buy a call for $1 and it's now worth $2, take at least half off. If the underlying risk was, let's say, $1, and the underlying has moved $2, twice the size of the underlying risk, then you can take half of your option position off. Let's take an example of the spider at $140. The cost of 100 shares is $14,000. If you bought a 1 month out monthly call, at the money call or put, you might pay $150. In other words, $1.50. And that's your maximum loss on the call, even if the market crashed. On the other hand, if the spider rallied 1% today, the profit would be $140 if you bought 100 shares of the spider, and it might be $50 if you bought one call. If the spider fell 2% today and you had a call, the loss on the spider would be $280 in the spider, and only $50 if you bought the call, approximately. If the spider fell 5% today and you owned 100 shares of the spider, you'd lose $700 if you bought the spider, but you might only lose $65 if you bought one call. Most daily stocks have a range of about 1% a day, and often more, and most move 2 to 10% within the next several days, and the options tend to move about half as much. So if the spider's at 140, it very often would be let's say 5% higher over the course of the next week. It might be 145, and the option might move up. If you bought a call, it might move up $2.50. So when should you enter an option position? As soon as the setup is clear. You look at the daily chart, the weekly chart, the 60-minute chart. Just before I typically enter just before the close of the day. Sometimes I'll enter at any time during the day if the market action seems like it warrants putting on an option position. But a lot of times, if I'm trading the daily chart or even the 60-minute chart, I wait for just before the close of the day because I want a strong signal bar before I enter. When to exit an option, usually when the position on the underlying tells you that the trade is over. So you, for example, you stay in until the always in direction reverses, and if a stop on the underlying would have been hit had you taken the position in the underlying, then you just go ahead and exit the option immediately. If the profit if you had taken a position in the underlying and the profit would have reached twice your risk, or if the option itself doubles in price, that's a good time to take half off, or sometimes even your entire position off. So if you buy a call for $1 and it's now worth $2, take at least half off. If the underlying risk was, let's say, $1, and the underlying has moved $2, twice the size of the underlying risk, then you can take half of your option position off. Let's take an example of the spider at $140. The cost of 100 shares is $14,000. If you bought a 1 month out monthly call, at the money call or put, you might pay $150. In other words, $1.50. And that's your maximum loss on the call, even if the market crashed. On the other hand, if the spider rallied 1% today, the profit would be $140 if you bought 100 shares of the spider, and it might be $50 if you bought one call. If the spider fell 2% today and you had a call, the loss on the spider would be $280 in the spider, and only $50 if you bought the call, approximately. If the spider fell 5% today and you owned 100 shares of the spider, you'd lose $700 if you bought the spider, but you might only lose $65 if you bought one call. Most daily stocks have a range of about 1% a day, and often more, and most move 2 to 10% within the next several days, and the options tend to move about half as much. So if the spider's at 140, it very often would be, let's say 5% higher over the course of the next week. It might be 145, and the option might move up. If you bought a call, it might move up $2, $2.50. Let's take an example of a stock that's currently trading at $100. And let's say you bought a 1 month out at the money call. At the money, 100. So you pay $2 for a at the money call, a 100 call. $2, it's for 100 shares of stock. So one call controls 100 shares of stock. You actually paid $200 for that call. If the stock rallies 3% over the next 3 days, 3% would be $3. The stock would be $103. The call would probably be up about $1.50, and you could sell it for $3.50 approximately, maybe a little bit less, maybe a little bit more. So you would have made $1.50 on your $2 call. That $1.50 is times 100 shares, so you would have made $150 on your initial risk of $3, of your initial risk of $200. Let's take an example of Apple. Let's say today it's trading at $600, and you thought it was going to fall, so you went ahead and you bought a 1 month out at the money put. You might have had to pay $27 for that put. Remember, that's times 100 shares, so your actual cost, what you actually had to pay, was $2,700. All right, and if Apple falls 3% over the next 3 days, 3% is $18. The put would move about half as much, and so it would increase in value about $9, and you could sell that put for $36 approximately, and you would have made $9 on your put. And it's $9 times the 100 shares that each put represents. So you would have bought the put for $2,700, and you would have sold it for $3,600, and you would have had a net profit of about $900. Some stocks are fantastic. For example, Apple, the at the money options for the nearest contracts on the monthly options, the volume is often 3,000 options a day, which is very good volume. In general, it's better to enter and exit monthly options with limit orders, although with huge markets like Apple and the spider, you usually can enter and exit at the market. And the bid-ask spread on stocks like Apple is really good. It might be 10 cents when Apple's trading at $600, which is very good. If it was a $60 stock, that would be a penny, and that's a very tight bid-ask spread. So you get very good fills. Which stocks to use? You can use any stock or any ATF, and you want the open interest of the options of the at the money options in general to be 1,000 or more. Sometimes less. 5,000 or more is better, because the more actively traded the options, the tighter the bid-ask spread, so the less your execution costs. Also, you want the stocks, the options to be traded fairly actively, so that if you're trying to get out, you want your order to be filled quickly. You don't want to place an order, a limit order to get out, and it just sits there for an hour or 2 or 3, because then you'll end up having to change it to make it a better price for the person on the other side, which is a worse price for you. So you either make less money, or if you're trying to get out of a losing trade, you lose more money. Okay, which stocks do you trade? You can look at the daily or 60-minute charts for setups. You look for best trade setups. You can look at the module on best trades, and if you see a setup, a best trade type of setup on the daily chart or 60-minute chart, then you should consider trading a put or a call or a spread on that particular underlying stock. Examples in 2012 of stocks that have very reliable options: Spider, Apple, Amazon, Google, Goldman Sachs, IBM, Gold. There are far more than that, but those are the ones that I look at pretty regularly. just about any stock can be good on any day if it moves enough. So if there's a special situation, some news event, some very boring stock can suddenly have very big daily ranges and huge volume in the options. Stocks with small option volume, sometimes they become very active and the bid-ask spreads then become very small, and the options can be traded extremely well, just like any other big volume option stock. Here's an example, the daily chart of TLT, which is the ETF that follows the 30-year Treasury bond. Let's say you have a possible major trend reversal. A top, you could look to buy 1 month out at the money puts. Once the price of the puts double, you can take half off, and then you could swing the balance as long as the TLT chart remains always in short, and you can hold until expiration if your thesis is still correct, that the market is still always in short. Here's the daily chart of TLT. The market's clearly in a bull trend and had a very strong bear spike, and then it went sideways for about 20 bars or so. So it broke the trend line by going sideways. It tested the moving average, and traders can look to sell a reversal down from a test of the high of the bull trend for a possible major trend reversal. Here we have a rally, and we tried to reverse here, but below a bull bar, and after 5 or 6 bars up, I would not take that short. Here we're around a double top, and this would be a second entry short, this being the first, and we have a decent bear bar. You can argue that the micro channel is extremely tight, and it is. It's a very, very tight channel. We had a micro channel here, a breakout, and now a pullback back into the channel. This is an extremely tight channel. In general, whenever the market is in a very tight channel, and I'm looking for a trade in the opposite direction, I wait for a second signal. I wait for the market to go sideways a little and then have a second signal. And that's what we had. We had the channel. We broke through the tight channel for a few bars, and so we had some selling pressure, and now we have another bear bar. So now we have a higher high major trend reversal, and we have a decent second signal. This bear bar was a first signal. I would not call this bull bar a decent signal. I would say this is a signal, this is a signal. Tight, it's still in a fairly tight channel, okay? Maybe it's better for it to round over some more. In fact, it probably is when the channel is this tight. That means the momentum up is so strong. But I would not be opposed to taking this short, since we're talking about options, buying puts. Okay, let's say you bought puts and were willing to let the market go against you a little bit. You'd still be holding your puts when the market did this. If you did not buy puts and you were waiting for a second signal and you saw the market fall below that bar and then had a strong bear close, you might go ahead and buy the 1 month out August at the money put. Okay, right now the TLT is around 131, so the at the money put would be 131, and you probably could have paid about $1.50 for it. You have a micro double top. Okay, the market went up and down, and a second signal. This was a decent. You could argue this is a second signal. This is another second signal from this one, and it's a higher high major trend reversal. My concern would be the tightness of the channel, but we're starting to turn down repeatedly here. 1, 2, 3, 4. I think the chances are pretty good of making a profitable trade. Alright, so you bought your put there, and then you got this gift, a big gap down and a big bear bar through the moving average. Your put now is over $3, so it doubled in price. In general, I don't like to get greedy with options because option profits disappear very quickly. Even if the market goes sideways, your profits disappear. So I always take at least half off if I get a double. So here, the option, you bought it for $1.50, it's now $3. I would take half off or even all off. If you took half off and plan to exit if the TLT went above your signal bar, and then you were going to let the rest swing, you might have taken some off here. Tight channel, I probably would hold. Here we have the third push down, 1, 2, 3. We fell below the bottom of a trend channel line. I don't have it drawn in. The puts expired over here on this day for $9.50. So $9.50 would have been in your account. You paid $150. The puts expired at $9.50. Your profit was $8. You would have ended up with $800 profit per put. Alternatively, let's say you had taken the earlier entry when the TLT was at 130 and you bought the 130 put, you would have paid $2 for it at that time. When the option expired over here, the TLT fell $8 from your entry price to 122, so your 130 put would have a value of $800 when it expired, and since you paid $2 for it, it's now worth $8. Your total profit would have been $600. $6 on the put times 100 contracts, or 100 shares of the underlying. If the premise is no longer valid, get out. You never hold on to a position and hope that it will once again go your way. Just exit, take your loss, and move on. Look for another trade. Remember, you're going to lose a lot as a trader. If you're good, you'll win 60-70% of the time. If you're really good, you can win 80 or 90% of the time. But if you're winning, 60% of the time, be happy. But that still means you're going to lose 40% of the time. So never get upset by a loss. Just take it and move on and look for another trade. Here's Apple. We have a bull trend and a very strong break below the bull trend line, and a test of the moving average. We fell well below the moving average, so you probably would start to look for a reversal down on any test of the high. So in other words, you look for a major trend reversal top on the next rally. Here we have a rally, and it has 3 pushes up: a bar up and then down, up and then bear bar and then up. So we have a lower high major trend reversal, and we have in the shape of a wedge bear flag. So that's a decent setup. A bull body for the signal bar, not ideal. So if you don't take the first entry, you could take the second. At the money, 380. So you can buy a 1 month out at the money 380 put, September in this case, and you might pay $15 for it, for this lower high major trend reversal. And then you see a few days later, Apple fell $25 and your 380 put rose $12 to $27. Okay, you paid $15, it's at $27. It's not quite 2 times your cost, right? But it's close, and it's closing on its low. It's reasonable to hold for more. But this is what you got instead, right? So instead of the market going down and hitting your initial target of 2 times the cost, the market reversed up quickly, and the market had 6 consecutive bull bodies here, and you're well above the entry price. At this point, the major trend reversal is unlikely, and the bull is resuming. If you held through all of this, most traders would not have held through 4 big bull bars like this, but had you held through it, you could have bought back your put for, or sold your put for $11 just before the close. So you paid $15, you'd sell for $11, you'd lose $4 times 100 shares, you would lose $400. Most traders, in fact, probably would have bought calls in here. Bull trend looks like it's resuming, or here, or here. And that is the end of my module on trading options on daily charts.